Good morning. Walt here with the Schultz team at Canopy Mortgage. I'm asked all the time, what are interest rates doing? What's the market doing? Where are we heading? So I figured that I would start to create a weekly market report and then send it out. I feel that this is important, especially in this day and time of where we are. There's a lot of uncertainty going on. The media is not being really kind. Remember, the media sells airtime. They have their own agenda. So I want to share with you really the truth behind the numbers. We're finding today that really anybody can change numbers the way that they want them to be. And so what we're doing is really showing you the truth behind the numbers and helping you understand is there's fears right now of again, a lot of uncertainty of interest rates climbing, of the housing market crashing. The media keeps playing that tune. The reality is that that is not so. We know that inflation is starting to trickle down. We had some numbers for this last week showing that. And as inflation trickles down, then so will interest rates. It's happened every time since 1955. As the rates have increased, the Fed has hiked the Fed funds rate. The interest rates have increased. At that point, the Fed's always pushed us into a recession, which is coming. Technically, we're already in one, but they'll push us into a recession, and as a recession hits, interest rates always move lower again since 1955. So, if something's different than 1955, we can talk about that, but the reality is that interest rates will be going down. So now, as we're looking at housing, I want to share some information with you on housing. I'll do so here in a minute. First, I want to show you really where we are in the bond market. Currently, we're up 13 basis points on the day, which is great news, absolutely great news. Here's where we've been since March 9th. Remember, the way that the bond market works is that the higher the bond yield on the 30-year bond, the lower the interest rate. So you can see that we've been in an upward trajectory since March 9th. And that's partly due to the banking issues and some of the economic news that's come out. Remember that typically negative news in the economy, such as the banking issue, will cause uncertainty. And uncertainty at that point, it causes the stock market to sell off. This is in a general rule, causes the market to sell off. And then that money will then go to the bond market. As it goes to the bond market, it's going there for safety and security. The yields in the bond market is not as high as the yields in the stock market. So therefore, people have a tendency to put their money in the bond market for safe yields, safe returns. So as we see here, again, we're in a good upward trajectory. So interest rates have gotten better since March 9th. Now, as we look at this, I want to pull your attention to one thing, which is the 200-day moving average right here. As we look at the 200-day moving average, you'll notice that we've pierced above it once, twice in the last close to a month now, 3 times it looks like, but each time we've finished out the market below. So we've ended up below the 200-day moving average, which creates this creates a ceiling for us. We keep hitting that ceiling, pierce through it a little bit, but then come back through, and so that has been a ceiling for us. So we're kind of stuck on interest rates when we're doing that. Interest rates can improve when we can pierce through that ceiling, and that ceiling becomes a new floor. So we're going to be looking to be able to pierce through that and then stay above it the rest of the day, finishing out the day above that 200-day moving average. Now, again, when we're looking at really housing and what housing is doing, I want to bring your attention to one chart here real quick. And this is the, thanks to our friends at MBS Highway, this is the home appreciation since 1942. So they went all the way back to 1942. And you'll see all of the green time. You'll see 1942, we were up 3%, 43, we're up 11%, 44, up 17%. And you'll see all the green time. You'll notice that in the pink here, those were the negative times. There are only a few negative times that we've had with home appreciation. In fact, we've had 73 positive years, 7 negative years, and then really one, it looks like 2 0 years where there were really zero appreciation. So the reality is, again, that housing is a good bet. Housing always has been a good bet, and it is a good bet currently. Now, as we look at last week's, what had happened and whatnot, we had annual consumer inflation continues to move lower. Signed contracts show housing is in a strong, standing strong. Again, the media continues to hammer housing, that there's a housing crash coming, but really the data does not show that. Again, remember, housing is a supply and demand issue, and we simply have much more demand than we have supply. The builders have said that it's going to take up to 10 years at least for them to catch up. We know that we're short about 3.8 to 4 million homes across the nation right now. And we know that we're creating around 1.4 to 1.9 million households every single year. We know that the millennials are driving the market, and we know that the Gen Zers coming up are going to be driving the market. We're talking about a population, the millennials are 85 million people, and then the Gen Zers are 60 million. So as those individuals start to climb through, the average first-time homebuyer is 31 to 33 years old. So as they start to climb through and as they start to purchase homes, as they're doing right now, the millennials, again, it's going to be creating that demand issue. And we know right now, again, we're down anywhere from about 3.8 to 4 million homes. Again, one thing I didn't share with you is that we're creating 1.4 to 1.9 million households every year, but we're only creating 1.2 million homes every year. So we're about negative 200,000 homes every single year right now. There was a significance of elevated continued jobless claims last week as well, which created some uncertainty. We know that as jobless claims continue, that's one of the first things that really trickles that inflation gauge as well. So this week, some things that we're looking for. Let me get to my report here. For this week, the latest data from the labor sector will be front and center starting Wednesday with ADP's employment report, which will give us an update on private payrolls for March. The latest jobless claims data will be reported on Thursday, and while Friday brings the Bureau of Labor and Statistics job report for March. So that's the big report, is Friday's report. We get some trickling reports Wednesday and Thursday, but really Friday, that's the day that it's going to really drive the market. And it will show us really where our unemployment rate is. The manufacturing numbers came out this morning. The ISM numbers came out this morning, showing that we're actually negative in manufacturing right now, which again is creating some uncertainty in the market. So as we look for this week ahead, really we're looking for really stability Monday and Tuesday. We're looking for some potential volatility Wednesday, Thursday, certainly Friday, depending upon what those jobs numbers come out to be. I hope this report finds you well. If you have any questions, please reach out. We're always here to help. Thanks. Have a great day. Bye-bye.